Hey, everybody. Thank you for joining in. This is a segment we started basically pretty close to when I started the channel, but we've come up with a whole bunch of new information, which is really, really exciting. But it does require a thing called self-awareness. And some people aren't interested in that, but those that are will be successful. And that's what this is about. This channel is about helping others find success. I want to say a big thank you to the team and Watson for helping put all this together. But as you guys know, the markets are hard, and we've been on the receiving end of trying to guide those as best we can. And as I always say, investing is a blood sport, but a key to success is knowing who you are. And this is a framework, two-part series on how to really do that. It will also include a little bit of homework at the end, and it's very, very important. If you want to be successful in investing, literally, there is a ton of work behind this, a ton of work identifying the key traits of the best investors in the history of the world, and helping you identify what your strengths are, what your weaknesses are, how you can shore up those weaknesses, and focus on your strengths. Again, self-awareness is key. And the most successful people in the world are very self-aware. So let's go. First of all, this doesn't matter. Why is this study important? So a couple of things. Again, we believe the key to success in life, not just investing, but in life, is knowing who you are, what you are, your strengths and weaknesses. Again, play to the strengths, shore up the weaknesses, and set goals and go after them. And after you achieve those goals, go after more audacious goals. And that is the key. And there's another key element here is pain plus reflection equals progress. Making mistakes is okay as long as you learn from those mistakes. I've made mistakes. We've all made mistakes. So let's just jump in. Now, the questions we asked ourselves to pull this together is really take what we've done already, but then layer in on top of that, what makes a great investor? How important is personality? What personalities do the top investors have? What are the common attributes of those top investors? Do archetypes exist? And is there correlation between attributes and returns? For example, time series, risk tolerance, etc., etc. We dug into all that and we have all the answers and we found a ton of correlations. So super, super interesting. But this took us weeks to put together. And there is nothing like this on the face of the earth that I've ever seen. And we've looked. So let's go. A quick refresher before we jump in, though. It's very important for all of you to know the difference between traders and investors. So traders basically are people that invest for the short term. That could be a minute, an hour or so, or a day, or a very short period of time. And they invest for short-term income, and they use this income to pay their expenses of life. Investors invest for the long term. They invest for long-term income. They invest for life-changing wealth. They build long-term wealth, etc. And they compound the investment money that they make. That is a very, very big difference. It's very important you're aware of that. And the reason for that is because very few traders actually make money. And we covered this a year ago. Can you believe it's exactly a year ago since we did this? But 70 to 90% of traders lose money. Various websites and blogs even say it's 90% plus. And often they end up quitting. And there's a reason why we're saying all this too. The lifespan of your typical trader is 90 days. Now, there's a lot of people that came into the market last year into things like crypto, and they made huge gains on meme tokens and stuff in a short window of time, and then they thought they had the Midas touch. Well, I know for a fact a lot of them are no longer with us, which is sad because they should have, if they did make quick money, park it in something safe. Now, how do they lose? 70 to 90% of traders lose money because they have leverage on their account, or they play with high beta, high risk equities like penny stocks or meme stocks. Very, very high risk. The other thing as well, just to recap, no two investors are alike. We try and build categories, personality types, archetypes, and draw parallels. And there is important to that. But from a study from, I think it was Humankind or something, they surveyed 1,500 investors and their trades, and they discovered that everybody is unique. So everybody has a special factor. And even though you may fall into a category, there's ways of modifying traits, and there's ways of being an outlier to some of those big trends as well. So let's talk about some of the types and results we have so far. So a big part of this is looking at Myers-Briggs, And for those of you, I know many of you out there already know this, there are 16 Myers-Briggs types, and it's basically a 4x4 real simple matrix. And everybody falls into one box or another. And why do we care? Well, we care because it's very important for your investing strategy and keys to success. Now, 3 of these attributes are very important. We'll talk about these in the conclusions. But even if you do fall into a certain category, it doesn't mean it's game over if it is not a winning mix. So, for example, as we say at the beginning, self-awareness is key. At the top there, you see judging versus perceiving. This way versus which way. Obviously, people who judge know which way they're going. Then you have your thinking versus feeling. It's basically brain over heart. Your intuitive versus sensing, how you decision make based on information. And finally, introverted versus extroverted. So that's kind of the Myers-Briggs. Now, the breakdown between males and females is also super interesting. I know my channel is still only 10% female, 90% male, but the women should be growing. They just haven't. I'm not sure why yet on this channel, but we'll see. Anyway, the sex of personality types is very interesting. You can see the vast majority of males, about 12.2%, are either INTJ or ENTP. Then the second biggest category is ESFJ, ISFJ, and ENFP. So there is a little bit of homework at the end for you guys to profile yourselves, because that's going to be very important for part 2 of this video. Women, you can see ISFJ are the most common, with 17% of females, followed by ESFJ. But the contrast is extremely different to men and how women operate. So if you are a lady in the audience, watch this carefully, because the conclusions will be very important going forward as well. Now, average income by personality type. This is also super interesting. ENTJs tend to be high-powered individuals, and they typically make the most money. INFP tend to be humble and have the smallest earnings. But remember, this is a broad classification and not necessarily representative of the truth. There's always tons of outliers, so don't take it too much to heart. Second of all, income over time by personality type, getting away from average income, but looking at income over time. The ENTJs earn more ENTJs earn more early in their careers, while the ENTPs find stride in midlife, and they end up earning more over time, especially in their 40s and 50s. So just sometimes it takes different types of personality types a longer time to find themselves and find exactly what they enjoy. Third is income by personality preference. Here, having certain personality types as well can mean a big boost in earnings. For example, extroverts, thinkers, and judges typically earn more, especially the thinkers. Sorry, it's kind of simple when you think about it. Those that think a lot, if they think a lot about investing, they make better investors. So it does require some homework. So that makes a lot of sense too. And the personality types, most people know their types, but if not, please do your homework. Do a little online test. We'll drop a link below of some good ones, and it'll be important for later. But you have your E for extroverts, S sensors, T thinkers, J judgers, introverts, intuitives, feelers, and perceivers. And you can put yourself on the box here. We put this cheat sheet in that you can profile yourselves very easily. And again, most of you, it'll take you 2 seconds to figure out who you are. Now, the initial result from data that's out there that we could find is your typical profitability by personality attribute. There are key attributes that really matter, and that is, first of all, those that are INTJ typically do the best. And the reason we show this is to see how the legendary investors, what personality types they have. Now, INTJ does the best, and then thinkers and introverts do very well as judgers. But the people who are feelers and perceivers, they can let themselves fall into more emotional decision making, and also, very important, easily led by factions. Or they can hear something on CNBC, or hear something from a friend, or read something on Twitter about some cult following of some asset, and they can jump in. So be careful. It's important not to trust. Trust but verify, and always do your own research. So as we go forward, the initial conclusion so far is 81% of INTJ people are profitable traders. They make the best traders or investors, as they always see the negative in any situation, which causes them to be fearful and It also precludes having too much confidence going into a deal. They're very kind of like paranoid. I'm a little bit that way myself. Now, the dominant introvert intuition is a function best suited for analyzing complex patterns and takes time to fully understand a situation before pulling a trigger. Again, that's from Human Metrics. Detailed analytics are very, very important in this game. Second, high-level conclusion. Again, this is interesting, but in the past, it was said that introverts make better investors and traders than extroverts. But over the last 2 years, over the pandemic, introverts have been starved of human contact, and they've actually become more extroverted. So call it extra extroverted. So it's one that can easily change when needed. Again, an example of how an attribute can change. Now let's get into the new framework. This is all stuff that we've put together for you guys. This is what we call our new evaluation framework. And first of all, how we developed this new framework. We developed it by taking a sample of the major investors of our time, the legends. You know many of them. We looked at their investment history, their tendencies, their quotes, their personality types, their approach to investments, the returns their firms have generated to investors over time. And we found that investors that make a lot of trades, who like to move in and out of different investments across many industries, are very different to others. We found investors that focus on one very specific niche, and they take more of a long-term approach to investing. We found investors that approach investing like a math problem, highly quant driven, as well as investors that approached investing like a professional gambler at a poker table. Again, all over the place, but it's very important. Now, what we want you to do as well is look at this. This is our evaluation framework, and we took all of our top investors and we put them on the sliding scale. We have time preference. Do they prefer long-term or short-term? How frequently are they getting in and out of trades? We look at the analytical approach. How reliant are they on data versus preferring to rely on their gut feel, their intuition? And quantitative investors approach investing like a math problem and let the data dictate how they should invest. That's very much about what this channel is about. Whereas intuitive investors approach investing almost like a pro gambler at a poker table. They go by feel. What is somebody else wearing at the table? Who knows? And they will consider the data, but ultimately let their intuition drive their decision making. And then the focus, you got your broad focus versus narrow focus. It's pretty obvious. The key to anything in life is to have a narrow focus. If you're focusing on too many things, you're going to end up with average results. And then risk appetite. What level of risk are they willing to take? What types of investments are they in? Do they avoid risk, or they do take a calculated risk? So at the end, you'll see some homework that you'll have to fill out. Now, the top investors we profiled are as follows. We looked at all the major legends and threw in a few red herrings as well, just to test the model and to keep the model honest and make sure we're not casting any aspersions. This model is quant driven, like all our models, and based on publicly available information. There are some investors that have stood the test of time and have been successful over a very long period of time. For example, Jack Bogle, George Soros, Warren Buffett, and many others. You'll see some other names in there that you know: Stephen Cohen, Stanley Druckenmiller, Bill Miller, Jim Rogers, Jim Cramer even, Chamath, Cathie Wood, Carl Icahn. We took a smattering of the who's who of top investors, as well as some red herrings, as we say as well, just to test the model. In addition, we also built out this profiling matrix for individuals, and it's something we also want you guys to have a look at. So we looked at the time preference, so short-term versus long-term. We looked at the intuitive approach versus quantitative approach. We looked at the broad focus versus narrow focus, risk-averse versus risk-taking, and we built out a 16-box matrix, just like the Myers-Briggs, to see how these top investors would fall in. And the new investor styles, here we are. So this one is where we took those 16 boxes and mapped them out. So for example, the investor styles, our table will map all legends on this table to see if we can find trends. For example, L is for long-term, S is for short-term, I is for intuitive, Q is for quantitative, B is for broad, N is for narrow, A is for risk averse, T is for risk taking. So for example, if you see something like SIBA, that is short-term, intuitive, broad focus, risk averse. If you see LIBA, it is long-term, intuitive, broad focused, and risk averse. And one of them will not do very well. So I think you guys know which one it is. Now, we also built out an archetype development framework. And this basically is prototypes. And we took the 16 boxes and put them into categories of 4 different categories. We have farmers, we have explorers, trailblazers, daredevils, and surgeons or snipers. So the farmers are risk averse, long term, daredevils, risk taking, intuition driven, sometimes short term. Explorers, trailblazers are risk taking, quant, data driven, think Cathie Wood. And then your surgeon snipers are risk averse and short term driven. And everybody should fit into those boxes. And we'll see what the results are. So, for example, when it comes to yourselves, if you look at Cathie Wood, her time preference is long term, 3 to 5 years plus. She has a very analytic approach, deep quant models within her team at ARC. And I know people might say, let me step out here for a second, people might say, but ARC is doing really bad. When you look at ARC performance over the last 7 years, they've done incredibly well. They've done really bad over the last 12 months because it's been a risk-off environment and they are into very disruptive stocks. So they're the ones that get hit hardest first. But their analytical approach is second to none. That's why they were able to identify winners like Tesla very early. And remember, the key is if you can get in early on key game-changing stocks, they can make you a hero. And that's exactly what Tesla did for Cathie. Now, her focus is also very narrow. It's all on innovation and disruption, and risk appetite is very high. That's why the names that they're in right now are getting hit hard, because it's a risk-off environment. Now let's look at Warren Buffett. Love him or hate him, the guy is deep into his 90s and he's still going strong. And he was, it's interesting, I just found out the other day, I think over the weekend, he was 33% cash until last Friday, and he bought into an oil company called Occidental. So him and I actually, even though I think he missed the boat on some technology and he doesn't like Bitcoin, he's been very, very good in many other areas. He's extremely long-term focused. He's extremely analytical, but he reads everything. I don't know how much he builds quantum models, but he definitely knows everything about everything he invests in and reads every piece of literature on it. His focus is more narrow. They tend to be in things like safe value type non-risky plays. And again, risk appetite, very risk averse. They wait. He hates holding cash. And he was sitting on 33% cash for a long time. And that must have been burning a piece of his soul, kind of like the way it was for me up until Feb 24th. So he is a classic farmer in our prototype. Let's look at Daredevil, George Soros. Again, love him or hate him. He is characterized by taking a lot of risk and having a very intuitive approach to investing. He trusts intuition over data, but he's willing to take risks. And he values data, but attributes his success to intuition, making outsized bets that pay off huge. So one of the things that made this guy real famous before we jump in is he took down the Bank of England, and that was the biggest trade of his life. I lived through it. It was in the early 90s. He shorted the British pound, and he made over $1 billion in this trade. And this is one of the greatest trades in history as well. It was highly leveraged, and it was a beautiful currency exploitation. But remember, he put all his chips on the table, and $1 billion in the early 90s was a lot of money. But his time preference is also kind of like longer term. He's more intuitive, kind of in the middle between intuitive and quantitative. His focus is kind of not broad, but not too narrow either. He'll go where there's money to be made or an opportunity to exploit some type of poor valuation. And he's very heavy into risk taking. A big daredevil. That's hence we named the prototype after him. And next one is you have prototype surgeon. This is Bill Gross. Again, more of a short-term player, heavier on the quant side. Focus is quite narrow, and he's also risk averse. Now, he wants to get in and out with minimum risk. He's known as the bond king, and he's made his career buying and selling bonds. known for getting into and out of positions. Risk averse, super focused. Again, he only plays bonds. And the Financial Times, I think, describes him as the most active and aggressive bond investor in history. And he once ran the largest bond fund in the world. It was nearly a $300 billion fund. So these are kind of the categories, but that's only 4 of nearly 30 we walk through. Now, the homework before part 2 is very, very important. So first of all, we do this so you guys can be better investors. It's very important to know your personality type, identify which box you are here. Think of colors. It'll be pretty easy to know if you're introverted or extroverted. That'll be half the battle, and then narrow yourself down. Second thing, look at the investor matrix. Identify if you're short-term preference, long-term, intuitive, quant, broad, narrow, risk-averse, risk-taking. And finally, put yourself in the sliding scale and take a copy of it and just draw a red line or whatever where you believe you are. And then when you'll be able to see how you compare to other investors, how your preferences, your risk aversion or risk tolerance, your personality type compares to all the legends. And we have found a ton of interesting correlations. So remember as well, success is finding out who you are, what you are, your strengths and weaknesses, going after them, shoring up gaps. And of course, learning from your mistakes. Really, really, really important. And any weakness you find, part of this is finding those weaknesses and shoring them up. And part 2 on Wednesday, we'll look at the top 24 investors profiled, all the legends, see who you are most like, and see what they do and how they find ways to win. Then we'll look at the most successful legends and their personality types. We'll look at the correlation between time series and winning for them, correlation between risk and winning, correlation between analytics, quant, and winning, and where the legends fall in terms of archetypes, and the personality type mapped to returns and keys to success. And we'll see if that research is in line with our research from exactly a year ago. So this will be super, super exciting. So again, that's the intro. Do your homework, and we'll have part 2 with all of the data to share with you on Wednesday. We do it tomorrow only. We have Octa tomorrow, and people don't want to miss that. So I look forward to seeing you all in part 2, and subscribe if you want to see part 2. It'll be extremely interesting, especially if you want to go deeper into personalities and who you are and what it takes to be successful in this blood sport that I call it. So a big thank you, everybody. Hit the like and subscribe if you can, and I will see you all tomorrow. Thank you. And thanks to the mods and everybody in the chat too. Bye, everybody.